Look at the global market for platinum group metals. This chart shows a highly volatile basket spot price trendline over recent trading periods. Prices fluctuate wildly based on industrial demand and geopolitical friction, but recently, the basket has hovered stubbornly around $2,000 per ounce. Now, compare that market average to the projected Phase 2 life of mine cash cost at Ivanhoe Mines' Platreef site. They are modeling an extraction cost of $599 per ounce. Operating at less than a third of the prevailing spot price creates a massive margin structure. A cost base this low is highly irregular for deep resource underground extraction, where sheer depth typically drives operational expenses upward. A gap like this does not occur by geological chance. It is the output of a highly specific, aggressive capital execution strategy designed to force down unit costs through pure mechanical volume. To achieve this cost structure, the Platreef site is executing 3 massive infrastructure projects completely simultaneously. They are building distinct nodes without introducing operational bottlenecks. The pressure is entirely on the timeline. This concurrent engineering must hold together to deliver a near 5-fold increase in production by the end of 2027. Platreef is currently the mining industry's ultimate test case. It will prove whether concurrent, mega-scale engineering can permanently dictate a project's position on the global cost curve. The physical site sits in South Africa's Limpopo Province, located directly on the northern limb of the Bushveld complex. The surface footprint reflects heavy initial capital deployment, with Phase 1 infrastructure already validating the project's viability. But extracting material from this specific deep resource deposit requires highly mechanized, continuous mining methods far below the surface. The target is a thick, polymetallic ore body. The host rock contains a concentrated mix of precious and base metals within the same geological footprint. To maximize the extraction rate of this complex ore, the site requires a corresponding leap in structural capacity. That necessity drives the concurrent 3-node infrastructure expansion underway right now. This schematic maps the physical network connecting the deep ore body to the surface. We can use it to build out the spatial model of the mine. The first interdependent node in this network is shaft number 3, penetrating deep into the existing mine architecture. Its primary operational function is to permanently increase the total volume of rock that can be mechanically lifted to the surface. The completion of this installation drives a 5-fold jump in site-wide capability, bringing total available hoisting capacity to approximately 5 million tons per annum. Without this massive throughput, the site risks a severe bottleneck. If underground extraction outpaces hoisting, the production line stalls. Shaft number 3 removes this risk, allowing operators to hoist ore and waste rock concurrently. This hoisting infrastructure is now live, cementing the physical foundation for the Phase 2 scale-up. Extracting the rock is only half the equation. The material must go somewhere once it clears the shaft. How does the existing surface infrastructure process a sudden 5-fold influx of raw material? It cannot. Shaft number 3's output dictates a parallel, simultaneous expansion of surface processing power. That introduces the second engineering node. We shift our focus up from the subterranean shafts to the surface footprint. Right beside the original facilities, ground has now been broken for the massive Phase 2 concentrator site. This dedicated processing engine is scaled to match the new underground output, targeting a capacity of 3.3 million tons per annum. Constructing a surface facility of this magnitude while simultaneously operating and scaling an underground mine introduces significant execution risk. Ivanhoe Mines contracted DRA Global to handle the engineering, procurement, and construction management for this specific phase. DRA Global holds a proven track record on this exact site. They delivered Platreef's Phase 1 concentrator entirely on schedule in June 2024. To protect the critical path, procurement for long-lead mechanical and electrical equipment is already well underway. This active progress on the ground directly de-risks the schedule, confirming target delivery for the Phase 2 concentrator by Q4 2027. Finally, the structural model expands to reveal the third and final interdependent node. Contracted to United Mining Services, the shaft number 2 widening program poses an immense engineering challenge. The shaft was initially raise-bored, creating a narrow 3.1-meter pilot hole deep into the bedrock. Heavy industrial equipment is now actively widening the diameter of that pilot hole from 3.1 meters to an enormous 10 meters across. This requires a multi-year construction pipeline. By the end of 2028, this widened shaft will begin hoisting labor and materials. 1 year later, by the close of 2029, it will be fully operational for hoisting ore. When complete, shaft number 2 will be the largest hoisting shaft on the African continent. It provides the required physical capacity to support steady-state Phase 2 operations and eventually anchor the massive Phase 3 expansion. When we step back from the physical infrastructure and look at the annualized material output, the economic logic of this massive scale becomes clear. The Phase 2 expansion targets an output of over 460,000 ounces of platinum, palladium, rhodium, and gold every single year. Because it's a polymetallic ore body, the precious metal yield is accompanied by approximately 9,000 tons of nickel and 6,000 tons of copper. These base metals introduce a critical economic mechanism into Platreef's financial model: byproduct credits. This chart demonstrates the waterfall effect. Revenue generated from selling nickel and copper is subtracted from the gross extraction cost. This subsidizes the mining of primary precious metals, bringing the projected Phase 2 total cash cost down to exactly $599 per ounce. This extreme margin advantage is engineered entirely by using mechanical scale to extract and sell highly profitable base metals alongside the primary output. An asset capable of producing at this volume and cost profile for decades attracts a very specific tier of international capital. The project has secured heavy Japanese industrial backing through the Itachu Corporation. It is additionally supported by sovereign backing via the JOGMEC Consortium, with these Japanese entities holding a collective 10% equity stake in the mine. Foreign governments are investing here because all 5 primary outputs, platinum, palladium, rhodium, nickel, and copper, are classified as critical minerals globally. Platreef is the definitive proof point for how mechanized, capital-backed industrial extraction can secure a globally competitive supply chain at massive scale.